Over IRS Form 8915-F, Qualified Disaster Retirement Plan Distributions and Repayments. So this is a 4-page tax form. It's fairly involved, but when you sit down and take a look at it, it's not as difficult as you might think. It is a little bit daunting. So in this example, we're going to take the case of a taxpayer, John Doe, who took a qualified disaster retirement plan distribution in 2023 for the tax year of 2023 in response to a qualified disaster from that year. So before we get too far into this form, there are some definitions that you should know from the form instructions. So the first is that a qualified disaster distribution, there are some requirements to go over that. So a qualified disaster distribution is included in your income generally over a 3-year period in equal amounts. So if you took $12,000 in a year, you could spread that out over 3 tax years. You don't have to, but you can. So that would be $4,000 in year 1, $4,000 in year 2, $4,000 in year 3. So any repayments that you made before you file your tax return by the due date and no later than 3 years and a day after the distribution was received, you can reduce the amount of that distribution included in your income. Also, qualified disaster distributions are not subject to the additional 10% tax for traditional retirement plans or for 25% additional tax on simple IRAs. So the additional taxes that you would normally calculate on IRS Form 5329, you don't necessarily have to, as long as you maintain the characteristics of a qualified disaster distribution. So the requirements are for 2020 disasters other than the coronavirus, the distribution was made no later than June 24th of 2021. For disasters located or in 2021 and later, generally you have up until 179 days after either the disaster beginning date or the disaster declaration date, whichever one is later. So we'll walk through part of this. We'll walk through the top part of this, and then we'll start going over the specific disaster that's related to this case. Again, we are doing this for tax year 2023. This is also the tax year that we did this, or that the qualified disaster took place. We're only taking one qualified disaster, although you can list quite a few of them on here. So DR 4738-GA, that happens to be a disaster related to a hurricane that happened in Georgia. So Hurricane Idalia. So this is the FEMA website. You can go to it. We're kind of walking through this, but the incident period, so this hurricane happened August 30th, 2023. The designation was September 7th, 2023. And in this case, because this was after 2021, the qualified distribution date is 179 days after the later of either the incident or the declaration date. So now you could still use this if you're repaying coronavirus related expenses. This is where things start to get a little bit intimidating. So for the purpose of this video, we're going to keep this simple, no reference to coronavirus. So now the next decision you have to make is whether or not you use chart 1 or chart 2. And depending on which chart you use, you'll walk through the flow chart and then you'll discover which steps you need to complete in this tax form. So we're not using chart 1 because we did not check the box in item D above. So if you're only a disaster or one of your disasters is the COVID, we're not checking that, and you would not list coronavirus in item C. So we're going to use chart 2 because chart 1 does not apply to us. So let's start with, were qualified disaster distributions made to you for a disaster listed in item C above? Yes. So in this case, we're going to complete part 1 and then as applicable parts 2, 3, and 4. However, do pay attention to the lines in this flow chart because in certain scenarios, you'll find that you only need to complete certain parts of the form, or more importantly, you might find out that you can't use this form at all. Okay, so be careful when you go through the flow chart. So now we're going to kind of briefly highlight the 4 parts to this tax form. So part 1 is the total distributions from all retirement plans. Part 2 is the qualified disaster distributions from retirement plans that are not IRAs for either the coronavirus or for the disaster or disasters listed in item C. Part 3 would be qualified disaster distributions from IRAs for the coronavirus and disasters listed in item C. And then finally, part 4 is the qualified distributions for the purchase or construction of a main home in the area of disaster listed in item C. So in this case, our hero John Doe did take out qualified distributions from both workplace retirement plans and his IRAs, and he's using some of that money towards the purchase of a home in the disaster area. So we're going to be going through all 4 parts of this form. So now we're in part 1, we have to complete the disaster table. We're going to put in the same information that we had in item C above. If there were more than 2 disasters, then you would have to check the box and list additional information on a separate form. That's what that basically means, is that there will be additional documentation with more. It will have the FEMA number, the disaster declaration date, and the beginning date for the disasters. So we're only going through 1. So in this case, if you, so at the very top, if you completed part 1 of 2 or more forms 8515, on which you check the same year in item A, but different years in item B, there may be additional instructions. So if you had to do multiple ones where they were all for the same tax year, but they were in different calendar years, then there's additional guidance in the form instructions. For the purpose of this video, we're just going to keep it clean. So you'll notice that column A for the entire line 1A through line 1E, it's all grayed out. So we'll kind of walk through what column B is just a second. But basically, available distributions are in column A, and then qualified disaster distributions are in column B. So first, we have to report what the distributions were, and then we're going to go back and see if we can just carry those figures over to column B, or if we have to shoehorn certain information together. So in column in line 2, we're going to enter $10,000. Let's just say that John Doe took out $10,000 from his 401k. In line 3, we're going to report that he took out $5,000 from his traditional IRA, and he also had a Roth IRA that he took out $5,000 from. So now the one item that you would enter into line 1E before we did all that is $22,000. So if you check 2020 and item B up here in the tax information, then you're able to receive up to $100,000 in qualified distributions. However, in tax years 2021 and later, that amount is $22,000. Anything above and beyond that is not a qualified disaster distribution amount for that disaster. Now, if you're claiming 3 disasters, you can put them together and you would be eligible to take a total of $66,000 as a qualified disaster distribution. So our total amount of withdrawals was $20,000. So in that case, we carry that $20,000. We don't really have to prorate or shoehorn any of this information because $20,000 is less than that $22,000 cap. However, let's say that we did 15,000 and then we did 10,000 here and 10,000 here. So that's a total of $35,000. We basically would then have to prorate this amount because we're now capped at 22, right? So then we would have to go back and prorate the amount of qualified distributions for each one. And the form instructions kind of guide you into that direction. They kind of help you discover that. We'll skip that for this, but basically you're taking literally the prorated amount. So you would have to do some back of the napkin math and see what you would carry forward from, I guess I'll do one example really quickly. I'll have to do it offline. So that basically comes up with a rough estimate of what that $22,000 would look like. It's not exact, but I had not anticipated doing this. So you basically have to prorate that amount. So let's go back to our original figures here. Oops. All right, so now we're back at our original number because the $20,000 of the actual distribution is less than what was qualified. It's all qualified. And then, so in the previous example, you would have had to include the excess of that $35,000 over the $22,000. So you would be entering $13,000 in here. However, we don't have to do that. We actually have a zero amount in this line because lines 2 through 4 in column A are not greater than the line 6 amount. So in this part 1, we're calculating a zero taxable amount. Now when we get to parts 2 and 3, this is where we start talking about the rule where you can accept the taxes over a 3-year period. Right, so This simply is the taxable amount for any amount above and beyond what is considered a qualified disaster distribution. So let's go into part 2, and we'll talk about your qualified disaster distributions from retirement plans other than IRAs. So in this part, we did enter an amount on line 2, column B. That was $10,000. That was right here. So we're going to enter that down here. Now, the applicable cost of distributions, what the form instructions basically refer to this is as basis. And the easiest way to explain basis would be to take a look at your Form 1099-R. So your Form 1099-R should report the amounts of your all distributions from all retirement plans. So if you have your Form 1099-R from your workplace retirement plan, your 401k, for example, then you would take a closer look at the difference between line 1 and line 2A. So line 1 would be the total distribution amount, and then line 2A would be the taxable amount. If there's a difference, then the cost would be the difference. So if you had $10,000 reported in line 10 or line 1, and then you had $10,000 reported in line 2A as the taxable amount, then there is no cost basis. So for retirement plans, for IRAs, pre-tax money is not considered as part of your basis. Now, when we get into IRAs, then we're going to have to take an additional step of accounting for the basis that you might find on IRS Form 8606, which is the non-deductible IRA form. So in this case, it's just $10,000 minus 0. We did not have any cost basis, so we get $10,000. This is the taxable amount of your workplace retirement plan qualified disaster distribution. So in line 11, you can choose to not spread the taxable amount over 3 years. If you want to do that, you simply check this box right here, carry line 10 down to line 11, and then move on. Now, if you check the box here, you also have to check the box in line 22 and vice versa. So if you're doing one, you have to do both. If you don't do either, then you can't do the other one. So in this case, we're not doing either. So we're going to simply divide the 10,000 by 3. We get $3,333. Now, worksheet 2 is in the form instructions. We're not going to go through it in this video because that's for prior years. And in this tax situation, we're only focusing on the one distribution for the 2023 tax year. However, you would go through a worksheet that is in the form instructions. It would account for your prior year distributions as well as your repayments. So you can find that in the instructions. We also kind of walk through that a little bit in our article. So you can use that for reference. I would also say that if you're doing this for multiple tax years, you probably should be hiring a CPA to make sure that it's done correctly. This can get you can get very bogged down in the minutia of this. So I would say if you have more than one disaster event, and especially over more than one calendar year, or if you're still reconciling this with COVID distributions, you should have a tax professional handle all of this. So in line 13, you're going to add lines 11 and 12. This would be your total income. So in worksheet 3 is where you calculate repayments from prior years that happen to be in this year. We didn't repay anything this year because we took the distribution. So we're subtracting line 14 from line 13, and then we'll enter this amount as taxable distribution on line 1040 of this year. Now in part 3, You do need to make sure that you've completed IRS Form 8606 if you are required to do that. So if you entered an amount on line 3, column B, or on line 4, column B, then we'll go to line 17. If you did not, then you'll just go straight to line 23 and start with worksheet 4. So let's go back to line 3, column B. That would be your traditional, either traditional IRA, SEP, or simple IRAs. So we did put some figures in there. And then 4, column B, is for Roth accounts, Roth SEP, Roth IRAs, and Roth simple IRAs. So we did receive a qualified disaster distribution from an IRA that's reported on this year's 8606. So we're going to go ahead and enter that amount. So in this case, we're looking on offline. We're looking at John Doe's Form 8606, line 15B. This would be the distribution for his traditional IRA, I believe. So let's see, 15B is right here, and that is under the category of your non-deductible traditional accounts. In part 3, line 25, this is from your Roth accounts. So we just entered $2,000. We're saying $2,000 from each of those. And then we're going to enter the amount from line 3, column B, if there's anything. So $9,000. This is the taxable amount of qualified disaster distributions. And then again, as we did before, you can choose not to spread that amount over 3 years, but we're going to go ahead and just put that in. We're going to go ahead and split it over 3 years. So $3,000 for the tax year 2023, and then we'll kind of carry that forward into future tax years. So again, we did not do worksheet 4 or the corresponding worksheet 5 because we did not have prior year income from qualified disaster distributions. So in line 24, we're simply going to bring down the $3,000. We did not repay back any of this money, so this is fully taxable. And now in part 4, we're going to walk through this. We'll just pretend that John Doe ended up using this money to buy a main home in the disaster area. So here we're carrying down his FEMA information, the declaration date, the beginning date, and then the end date, which is 179 days after the latter of these two. And then he received his qualified distribution on the 15th of September. So he did receive what he didn't. Hold on. So in this case, we just selected that he did not receive a qualified distribution for the purchase of a construction or main home for the purchase or construction of a main home in the area of a disaster that is from an IRA and required to be reported on 8606. So for this example, this is separate from the other 3. In this case, I'm just walking through this. So in this case, he would enter the total amount of qualified distributions. You should not include any reports that were, any amounts that were reported on 8606. You should also not include any distributions on line 8 or line 20. So as you can see, we already put amounts in line 20 and line 8. So this is purely for just illustrative purposes. So let's pretend for a moment that we did not go through parts 2 and 3, and that money that was taken out just went to part 4. So in this case, we took our $15,000. Let's just say we had some basis. The cost of distributions was $10,000. So that means we only have about $5,000 left that needs to be considered for taxes. So on line 31, you can enter the total amount of repayments that you made. So repayments have to be made before the filing deadline of the tax return. So you would not include any repayments that are also treated as rollovers on IRS Form 8606. So in this case, $1,000, you would take that $1,000 away from the $5,000, and if this was a distribution from an IRA, you would put it on line 4B of your Form 1040, 1040SR, or 1040NR. If it's from a retirement plan, not part of an IRA, then it would be on line 5B of that form. So based on what you do with this, you may be subject to an additional tax on this line 32 amount. So according to the form instructions, basically most distributions from qualified plans are subject to an additional tax on early distributions. If you made a qualified distribution for the purchase or construction of a main home in a qualified disaster area that was not repaid to an eligible retirement plan within the specified time frame, may be subject to the additional tax unless you qualify for an exception. So the repayment period for accidents or for disasters that started in 2021 or later so the repayment period will end 180 days after the disaster beginning date. So in this case, you would have to, so if we repaid the full amount, then none of it would be taxable. You basically get to borrow that money for 180 days and put it back within your retirement plan. So in this case, we only paid back $1,000. Then in that case, we would still owe taxes and possibly an early withdrawal penalty on the remaining $4,000. So, and again, that gives it, I mean, you know, at the time of this recording, we're before March 6, 2024. So for something that happened less than 180 days ago, you could feasibly repay this with your tax return and not have any taxes on an amount that you withdrew and repaid back within 180 days. Technically 179, so less than 180 days. So this is not the most straightforward tax form. It is a little cumbersome. I expect that when they release the next year's version, it may be a little bit more streamlined, as we'll be getting out from under the, hopefully, the coronavirus related disaster repayment structure. So hopefully this form will look a little bit easier when we're filing 2024 tax returns in 2025. So we do cover this in a little bit more detail in our article. You can check out the link in the show notes or simply go to teachmepersonalfinance.com, type in IRS Form 8915-F, and you should see our article appear. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if you have a question about a tax topic that you would like to see covered in an upcoming video, please hit us up in the show notes. One final comment: any tax forms that were mentioned in this video, we'll put links in the show notes to articles and videos that we've created about them. So that's all we have. Thank you very much and have a great day.